Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Barry Martin. How you doing today, Barry?
Good, Kirk. Thanks for having us on. Appreciate it.
Yeah. Thanks for coming. So this is an interesting interview. We haven't talked about this topic in a while, and wanted to bring Barry on to talk about it. Barry, tell us a little bit about your background.
Basically I'm a covered option writer. So I've been doing it for maybe 25 years now. Pretty basic stuff, but with covered option writing, you're buying stock and selling someone the right, but not the obligation to purchase the stock off you at a predetermined price in the future. So if we're doing it over 25 years, it's gotten pretty crazy in popularity the last couple of years. They have a category in Morningstar called derivative income. And a couple of years ago, it was at $7 billion, and now we're at 75 billion. So, it's funny, doing this for so long. It used to be, I don't know, a secondary approach to looking at things, and now it's become pretty popular. So I've been doing this 25 years. I've been at Sheldon Capital Management for about 8 years. Sheldon Capital is a boutique asset manager based in Denver, Colorado, that manages about $5 billion. Of that, I manage about 1.3 billion, and that's all option overlay strategies, which is basically covered call writing.
Nice. So you mentioned this has gotten a lot of interest in the last few years. What do you attribute that to? Because a lot of things have happened in the last 5 years, but what do you attribute the change in interest in covered call writing?
I think a couple things, when we were doing it a while back, it was expensive to trade these. So when commission structure have gone down dramatically. So I think that's a big factor. I mean, when I was doing this, you'd buy the stock, that'd be a commission. When you'd sell a call, that'd be commission. When you had something, an assignment, that'd be a commission. You buy back commission, and you're trading shorter dated. So you're doing a lot of trades around this process. But as we all know, commissions have dropped dramatically. Sometimes it's free. And so I think that's become more popular. Also, I think options education has been a big factor. You see the likes of the old TD Ameritrade, now Schwab and Schwab, and you see a lot of advertising about option trading. So I think that became more popular. People now understand it better. There's a conservative approach to option strategies, and there's obviously a very risky approach to option strategy. So I think the education from professionals to the retail market pushed it. And also third, I think, a couple of years ago when we had the meme stock craze, a lot of option trading was happening during then. And so that became popular and became newsworthy. And so I think, a lot more people just decided to branch out, and with the education, the popularity, and just it's become a lot cheaper. It's become very popular.
Yeah, it's interesting. It's funny because you would have thought when you had interest rates at 0% for like 15 years, people would be pursuing this, and yet there wasn't a huge push during that period, right?
Yeah, and is actually pretty hard for our job. When you're in a ZERP environment, and when we had the VIX at single digits, selling options wasn't the most beneficial thing, because interest rates and volatility is a big factor in call pricing or option pricing. If you look at the Black-Scholes model, that's one of the two factors that is part of the process. So when the interest rate environment zero and the stocks are just chugging along, selling options probably wasn't the most appropriate. It depends on what you're doing, but in general, covered call writing wasn't the most appropriate because you're not receiving that much from selling calls in the future. But now with the VIX back to its norm, which is in the teens, and with interest rates increasing, it makes a lot more sense. And I think that's one of the main reasons why it's got, the money has flown into this strategy, because the performance has followed. We're selling covered calls, and we're getting similar returns to the market with about a third less standard deviation. So I think that's important for people, because basically you're dampening that risk. You're getting to the same spot with lower risk, lower movements, up and down. So I think that's a huge factor. And that's why these type of strategies have a lot of wind in its sails.
So let's talk about with investment strategies, some investment strategies are good in some markets, they're not good in others. There's no best strategy for every market. So what are the best markets to use covered call writing in?
Yeah, I think markets where volatility is a little bit higher, which we're in now. But also with covered option writing, I think you want a choppy sideways market for superior performance. Most of the clients that we use, and most of the people that use this as an income strategy. I would say about 70 to 80% use it as an income strategy. But this performs very well when you have a choppy sideways market, or slightly up and choppy, or slightly down and choppy. Basically how we run this portfolio is that when you own, let's use Apple because everyone knows Apple. Apple's at $170 a share right now. You have multiple options to sell, but you can sell right now. I'm looking at the market. You can sell the April 180s, which are 37 days out, for $1.60, or you can sell the May 185s for $2.38. So goes with what type of market works well. Well, in reality, if Apple stays at 170 to 180, down to 160, 170, like stays in that choppy range, you're going to collect that $1.60 every 37 days. And so that's where it's benefit. Now, when you're only getting $1.75 for that, right? When the VIX was at 9, when it was at 2017 through 19, when that is low, and then before you know it, Apple's at 200, you didn't really make out, because in that case, you should have just owned Apple. And so you have to be aware of what you're looking at and how you want to play it. If you're really bullish on the stock, covered call writing doesn't make sense. If you feel that the market is somewhat peaked, then covered call writing makes sense. Or if you're willing to exit at a price in the future, it really makes sense too, because I look at it as basically you're getting paid to exit at a higher price. So in this case, you're like, hey, Apple's at 170. I like 185. That's my exit point. You can sell that call at 185, take the premium, put in your pocket. Never gets there, you can do it again and do it again. But it does get there. Hey, you go, hey, I'm clear, I'm clean my hands with this Apple at 185, and we're out. So those are the type of markets that we like, and what we're seeing the last couple of years.
Okay, so basically sideways market, slightly up, slightly down are the best strategies. The worst strategies are big up, big down, right? Because you're giving up too much.
Yeah, I mean, because it goes to one of your earlier podcasts, you talked about asymmetric returns. With covered call writing, you have asymmetric returns. So your upside's capped at a certain level, and you have a lot of downside risk with owning covered calls. So a dramatic upswing, you're capped out at a certain level. A dramatic downswing, you get that downswing minus the, we attempt to generate 6 to 9% in cash flow. And so, and an option premium. So you're down 30% minus the 6%. So you're still down 24%. So it's kind of like, hey, you got to be careful of those swings. So how we write covered calls is I think different than others, is that we don't chase big premiums, because big premiums have a lot of risks. Like, why are the big premiums? I'm like, oh, because there's downside risk and there's a lot of upside risk, right? And so there's covered call writing products out there. Like, for example, there's a product called the QYLD. It's not our product, but it's the NASDAQ 100 with covered calls written on it. I'm not a big fan of that, because I'm going to buy the NASDAQ for the upside, right? I mean, that's why you buy the NASDAQ. You want that upside. So why cap that upside, right? Why write a covered call on the upside of that? So, but like on the flip side, you have a lot of downside risk of the NASDAQ 100. So it goes back to the asymmetric returns. You got the downside risk of the NASDAQ and really no upside. I mean, maybe you can get 5 to 10% upside, but you get the big cash premium. So people are attracted to these big cash premiums, where we say, hey, that's if you look at a stoplight, that's a kind of yellow light there. It might be even red. When volatility spikes, there's something, not necessarily wrong, but there's nervousness out there on that specific stock. So you have to be careful of that. So we're wary about chasing big premiums. What we try and do is, it goes back to the asymmetric returns, is that we buy stocks with a defensive quality. Market leaders, stocks that have large market caps, stocks that generate free cash flow, basically stocks that minimize that downside risk as much as possible. So to use an analogy, if the speed limit's 65 mile an hour, we're buying stocks, we're driving 50 miles an hour trying to avoid potholes because of the asymmetric returns of covered call writing.
Yeah, it's a good perspective. Now, what type of stocks are typically the best for covered call writing? You said the Nasdaq obviously is not, but there's different types of stocks. There's growth stocks,
Right.
there's value stocks, and of course the premiums will vary based on which one you use. So is there like an optimal type that you look for?
Yeah, so I think most people I know, we're different. We look at blended, so we're kind of across the board, but there are more, I'd say, covered call writers look at value because they believe of that downside risk. They think it's, what you own is, they're aware of the downside risk. So there's a value tilt to most covered call writers. I'm on kind of the other side where I'm more of a blended. So, bring back the NASDAQ example, the NASDAQ 100. I like writing covered calls on an Apple. I like writing covered calls on Google and Amazon, um, mainly because they generate free cash flow. They crush it on revenues. They have the defensive call and they're market leaders. Those type of things, and they have a little volatility in it as well. It's not crazy vol, but it's average market. Apple is probably average market, but Amazon, Google's maybe slightly higher. So Goldman Sachs did a white paper a couple years ago looking at factor analysis on superior covered option writing. They actually look at secured puts, but it's very secured puts and covered call writing is actually mathematically very similar. And so the two factors that came back for superior performance on covered option writing was one, free cash flow. So stocks that generate free cash flow tend to do better with covered call writing. The second factor was actually market cap. And market cap that probably goes back to more of a defensive quality, but also I think maybe there's some liquidity in the option market with higher market cap securities. The bid-ask spread's tighter, so there's better performance. If you're looking at a stock, I mean, I prefer looking at fundamental analysis, but focus on free cash flow and also larger cap equities. I think if you're looking at a small cap security and you're looking for upside, I think that's where you're buying calls, right? So you're going out further buying calls. For the type of equities that we own, you're selling calls. I think you want to go shorter dated, large cap equities that generate free cash flow.
So you mentioned cash covered puts versus covered calls, which I've always been puzzled by this, is that, from a risk to reward, they're identical.
Yeah.
But, some firms look at cash covered puts as riskier. It just, I mean, it boggles my mind. TD was always great at this, but I know some of the other firms would look at it and say, well, actually, they're riskier. I'm like, really? Because I'm pretty sure it's
Yeah.
identical. So who's doing your risk management over there? But how do
Well,
you see that? Like, why wouldn't you just do cash covered puts?
yeah. So, I mean, I think some people equate to being um, riskier is that they don't use the cash secured part.
Oh,
So
okay. Yeah.
they're just selling puts on a portfolio. So it makes you, double long and especially you're long on the down, but not really on the way up. But if you have a genuine like cash set aside for this put assignment, then it's exactly the same. I'm a fan of it. People have done very well with it. I think the problems that came up was, the whole people had large portfolios and selling index puts out of the money. So maybe 10% out of the money. And so you collect this premium. But what happened was it's almost like, the whole analogy where you're picking up nickels in front of a steamroller or
Yep.
whatever. And so you have the big swing down and then you just lose everything and you don't have the cash set aside. It's on margin, but technically it's not. So that's kind of the problem with the put writing side. That doesn't happen in cover call writing, right? So because you're buying the stock, selling the call, you have a huge upswing. Your call that might be naked is not naked. You have the stock, you just deliver the stock. So I think from that standpoint, it technically, if you have the cash set aside, it's fine. But on the flip side, a lot of people really don't do it. They're just kind of selling puts, and before you know it, they get put stock, and they're using leverage by accident. So I can see that happening, and so it happened in the past.
Okay. And then one other thing that kind of comes up as I was thinking about this, I know nobody really talks about this, is, instead of doing a covered call where you're selling a call and you're buying the stock, why not just do a spread? I mean, you'd reduce the
Oh yeah.
downside risk, and then it's usually 3 to 1, but at least you're capped on the downside. Like, why wouldn't that come into play?
Yeah, so I'm a big believer in spreads, especially put spreads. So when you think of a stock, people would say, "Hey, let's lose Apple example. I want to buy a put on Apple." Um, and now, when you buy a put on Apple, you're basically buying a put from, let's say, right now it's at 170, and you think you want to buy, you think Apple's going down, so you buy a put at 160. So, and the 160 puts right now are $1. So you're going to basically pay the April, which is 37 days out, April option put that you think Apple's, and you're going to pay that dollar. So if it drops below 160, you're going to every dollar you make $1 basically. So now you buy this one put for $1. You're like, hey, that's great. I'll pay $1. But you're getting Apple from 160 down to 0. What are the odds of that happening? Very minimal, right? So why don't we do a put spread where you actually get that range? So for example, if you spend that same dollar, you can buy now the 165 puts and sell the 155 calls, or 155 puts. So that's that put spread. So now you have, instead of getting 160 all the way down, you have the same amount of price. You can do the 165s to the 155s. So it doesn't make more sense that Apple's, if it drops below 165, I mean, 155 might be the end of the drop. I mean, no way Apple's going to go to 0. So that's why we like put spreads when you're buying protection, because it's more of a range that you predict, and because of that, this, for the same price of paying the 160 all the way down, you get the 165, which actually is way more beneficial to the 155. And if it drops below 155, you get the same amount of money. So it works out pretty well. Yeah, we're big put spread believers, and I think that makes the most sense of how to protect one's position. Unless you actually think the position is going to go to 0, then you can buy the put.
Yeah, it's funny how, I mean, you know what else is funny is usually when I see spreads, when you look at the custodians where they rank the spreads, they also rank spreads as
Yeah.
more risky when actually they're less risky than just going, just buying a call or buying a put and that's it. But
Yeah.
using a spread is actually less risky, but they deem it as more risky, which another question that boggles my mind, like who is running these firms? Like how do they perceive that as more risky?
Yeah, we have that frustration as well. For example, like the put spread example, like we can do married. So that means basically you can buy the put only if you have that call there. And so, or sorry, buy the put only if you have that stock there. But you
Right.
can't do put spread, and you can't just buy the put or sell the call. And no matter how advanced the client is. So those are some of the frustrations that we're coming to. But on the flip side, it's gotten better. I think the levels have changed, and as go back to our original point, as the popularity increases, I think there will be more available process, because I know you can only do certain things in, let's say, qualified money in like an IRA or something along those lines. Like we can do covered calls, but that's pretty much about it. And you can do callers, but outside of that, they limit that. But I think that's going to come our way. As long, especially technology too. I think maybe they can't even track like a lot of times the technology can't track a put spread, and you go, hey, this is married to my large concentrated position. I'm doing a put spread on this, and they go, well, technically it's not, blah blah blah. But I think as technology gets better, I think they're going to fit that in, because you're right. It's more conservative than just owning the stock outright, and you're allowed to own the stock, right? Stock outright. So there are possibilities. I think that will come our way hopefully soon.
Hopefully.
Yeah.
Yeah, I think you and I have similar frustrations and they'll never say it's technology, but I think actually in thinking about it, you're right. That does make the most sense is that it's technology they don't have in order to track it, so they just say no. Um,
No is
but
always the easiest answer.
no, yeah, no's easier than just trying to figure it out, right?
Yeah,
Which
exactly.
actually brings up another interesting point is that a lot of people think options are risky.
Mhm.
Now I end up, we do a lot of options internally here. So we do them and every once in a while I get a CPA is like who tells a client, what are you doing options for? Those are risky. And meanwhile, the client's doing covered calls on a
Right.
position that he's owned for like
Exactly.
10 years and we're doing covered calls. He's like, you shouldn't do those are risky. And the client freaks out. I'm like, oh my God, it's not risky. But like, how should people be thinking about this? Because they're getting false data from CPAs and sometimes from advisors who just
Yeah.
advisors don't know either. Like advisors are not options people. Like there's maybe like 5% of advisors who are playing around with options, mostly because their firm won't let them.
Yeah, no, exactly. So there's two ways to look at it. I mean, a lot of times we bump into this. And so that's why advisors hire people like me. We come in and say, hey, we can help you with this. And then the advisor goes like, you know, I know this works. I don't want to deal with this, but I know it makes sense. So why don't you guys take it over? And education, I goes back to it's become very popular, and I think education is the number one key. You have to talk through it. So a lot of advisors are nervous about that because it just takes a lot of time. But with I just think that the popularity has driven it down. I think you know doing this 25 years, it's night and day from what it was 20 years ago. You're right. I've had plenty of the CPA examples. Another problem with options mostly are short-term capital gains. So you have to be aware of that. But income's income. So you have to pay taxes if you're making it. So, and then, I think with the CPA side, especially some of our accounts. So we have SMAs where it's a 30 stock portfolio. We're buying stock, selling calls, and the CPA gets our transaction report at the end of the end of the year. I got 12 months of selling 30 call options, and they're just like, oh, so that could be something to do with it as well. They just don't want to deal with the work. But but it goes back to your point. You're right. But I think it's gotten better. It's definitely gotten better over the last couple of years, and the costs have gone down dramatically. And I think that just fits into the retail client, and they're starting to use it and play around with it and have fun with it.
Nice. So,
Yeah.
what are some good rules of thumb to follow with this? Because I know options, in my opinion, people talk about, well, people shouldn't trade options. And I agree. Most people shouldn't because they just look at it as a way to find leverage and end up losing a lot of money. But then they say, well, options are risky. And they're really not because they weren't designed to be risky. They're designed to manage risk. It's how people use them.
Yeah.
So, what are some good rules of thumbs that people can follow if they want to utilize options in their portfolio?
Yeah, I think the good rule of thumb is use like a golf analogy is that when you're playing golf, you want to avoid the sand trap, you want to avoid being short-sighted, you want to avoid out of bounds. So there's things that you have to be aware of where you try and minimize your risk, right? And I think when you first start out, you should do basic stuff where it's like covered call writing. We're the covered call writing is the lowest level of risk, and then as you get familiar and get your feet wet, then you can move on to other things. But I think that the main thing is to minimize risk. Realize that you do have asymmetric returns when you're writing covered calls. And I think trade with stocks that you're familiar with. I wouldn't, if you're not a trader or if you're not familiar with the market, I don't think options should be the first step of the process of learning the market, but it is something that you can do, down the road. And so I think the main thing is educating yourself and minimizing risk and just know what the next steps are and kind of the, best case, worst case scenarios. And I think you should be fine.
Okay, cool.
Mhm.
Um, so, obviously we've got elections coming up and it seems like there's always some sort of black swan on the horizon or some big event and, that never really comes to pass. But
Yeah.
how can people take advantage of that? Because people think that we're going to have a civil war in this country, which I always laugh because I'm like, really? Because I've never met a person who wants that. So it means it's
Yeah.
not going to happen. Right. But
Right.
everyone thinks that and they're like, oh my God, the world's going to blow up tomorrow. And of course, that plays into the options market at some level. So how can
Yeah.
people be thinking about this moving into some of these bigger events?
Yeah. I think, you look at things, we have right now we have the election, obviously. So historically, the market's been fairly sideways until you get some clarity, then it goes one way or the other. And we don't really know which way it's going to go. I mean, 2016, when Trump was elected, the market got crushed, and then the next day it was up, 10%, whatever it was. And so like people really had no idea what the effect would be for that. I think the bigger factor is, the Fed and their cuts versus what the market predicts, and if the market doesn't get what they want, does that have an effect on it? Obviously, you have this micro or macro, global issues happening across the board, around the world. So all these things come our way to a certain extent with volatility and us selling volatility. So when you're selling cover calls, basically what you're doing is you're generating additional cash returns by monetizing the volatility of underlying positions, and you do that by selling covered calls. So, like you said, it you have these big events that people worry about, and they tend not to happen, or it tends to just flatten out. So that's where the benefit of selling options do, because you're selling that vol, and so people expect something crazy to happen, but the baseline is here. So that differential is what they call the volatility risk premium. And so and basically when you sell options, that differential is where you generate alpha. So sometimes that VRP, volatility risk premium, is wider, and sometimes it's tighter. So when the market and the VIX was lower, that volatility risk premium was tighter, and now we're starting to see that expand. And so the best benefit, I think, for that is selling options, and that's kind of how you take advantage of unknowns and nervousness and people freaking out. And so that's basically what we're doing.
Yeah, it's funny. I remember I think it was in April 2020, right at the peak of craziness when the VIX was, I think, 80.
Yeah.
I was looking around, and at the time it didn't hit me, but I looked at it a little bit after that, and I realized, like, well, the VIX was 80.
Right.
And if you look back at the numbers, you could have sold a put on the S&P 500 and made 35% on at that point. So it could have dropped 35% before you lost money, which actually would have been a good buying price.
Yeah, exactly.
But if it went up, you would have made 35% in a
Yeah.
year. It was
Yeah.
crazy. And
it's insane. Yeah.
and in hindsight, I kick myself for not doing that. I was like, God, that would have been a great move. But I didn't, because like everyone else, I was afraid. Like the whole world shut down, and what's going to happen? Everyone's stuck in their houses. The stock prices should be zero. I mean, it's Great Depression kind of stuff. Like,
Yeah.
price,
Right.
things go down 90%, and that was the fear. Like, oh my God, things could be down 90%. Um, and I guess in those extreme examples, or like March of 2009, like we were looking at the market, we started taking pot shots and buying some stock, and my business partner's like, "Hey, should we invest in Citigroup?" And I think Citigroup was trading for $1.
Yeah.
And I was like, wow, $1. What are the options like on that? And I was thinking to myself, wait a minute, it is an option at a
Yeah. Yeah.
dollar.
Totally.
You know?
Well, you get that level. I mean, you can be creative too. Is like you're selling, you sell that put, you get that money, then maybe buy outdated calls like way out in the future, with that money, right? So
Yeah.
you can kind of sit there like, oh, I can get some upside over here. But the process, you're right. So you're like instead of being 35%, and then maybe I take half of that and then buy upside calls. So there are ways that people can get really creative on how they attack these things, right? Especially with options, and obviously you get the leverage. As I don't know if you follow like Nancy Pelosi's portfolio, like
Oh
she's
God.
buying,
Yeah. Nvidia. I
yeah,
heard.
Nvidia outdated leaps
No,
like
no, sorry.
crazy.
It was
Well, Nvidia was one of them for
Pan
sure. Yeah.
W. I
Oh
always
yeah,
forget
Palo
the
Alto Networks.
Palo Alto Networks is what she
Yeah.
bought options on. That was the one, and immediately it spiked, and then it came down. I'm just like, all right,
Yeah,
maybe
exactly.
like
Yeah.
it's a little comical on that, but yeah, it's just it's priceless.
Yeah.
There's no
I mean,
words.
it is funny. It's so like, and I think that, that tracking's pretty funny, but, buying out longer outdated calls, in general plays out pretty well, especially in those type of markets. Obviously there's a lot of volatility, so they're expensive, but the market's already down 35% or whatever it was. Yeah, it was down 30, then it started taking off.
Yeah, it was 30, 35, and then you could also get another 35% protection by selling the puts, and then I mean, that's 60 some odd percent. At some point, you just got to go all in. I mean, even the global financial crisis is only down around 60.
Yeah.
So, and that was bad, world ending stuff. And of course, the whole the economy wasn't shut down, but still. So, yeah, it does bring in some perspective. Like those who can keep their head in those times can make a lot of money. Um, but yeah, no, yeah, I really appreciate you coming and sharing with us. Any other kind of suggestions you can leave our listeners with about covered calls and why they should have this in their portfolio?
Well, yeah, I think, going forward, what we're seeing is uh, some frustration with the 60/40, that's the standard 60/40 portfolio. 60% equities, 40% fixed income. We've seen inflation spike, obviously, and we've noticed we've run some work on inflation and on the 60/40 portfolio. So as inflation is over 3%, the correlation between those two products actually increased. And so, it was 2 years ago, 60/40 portfolio was down pretty dramatically. It had a pretty good year, okay year last year because the market was up. But as these correlations increase, I think it's important to look at your portfolio as a whole and go, hey, fixed income and equities are starting to run together. Let's look at something different to add to the portfolio. And I think that's where a lot of these positions have been added, a derivative income, some of those lines, because it doesn't exactly perform like equity and doesn't perform like fixed income. So it performs differently. And I think adding alternatives to one's portfolio makes a lot of sense. And this is something that I think clients and advisors need to look at better instead of just going back to your, hey, I'm going to do fixed income here and equities here. I think we should all have a better, look at the core satellites and add multiple things to the portfolio to reduce that risk while achieving the same returns.
Now, do you think because there's so much fixed income that now is in ETF format, do you think it makes sense to actually look at covered calls or option strategies around fixed income? Have you ever done any studies on that?
Yeah, so we look at I've in my personal account I've done cover call writing on the TLT, which is the long end of the government, and I think it's worked out pretty well, except TLT hasn't performed that great. So you're taking income off that, so there are products like that you can do. It's just kind of what your belief on what the market is going to be going forward now. Some of the shorter dated, if you're shorter curve selling options, I don't think that makes as much sense. But I think longer dated fixed income or on the end of the curve and selling calls on that, on those ETFs, that works. Yeah, definitely.
Okay, interesting. Yeah, I'm just looking at it right now, and yeah, I mean it's still not great, but
Yeah.
I guess if you can get 3% on TLT out to January, that's 3% plus what you're getting on that anyway, which is not even five at this point. But yeah,
Yeah.
I guess if you're talking about fixed income, it's a good way to do it.
It's when we like, I mean, so right now, like if we just look at, yeah, you're saying like the TLT's at 94.51. You can sell the June 100s for $1. So that's not bad, you know. And you got it's a 30-year bond, so say it's pretty conservative. They go hold up.
So here's a question, and I know the answer, but I just want to ask it with the
Yeah.
listeners. So it's trading at like, let's say it's trading at 95, it's 94.50, but let's say it's 95. So, well, actually, here's an example. So it's
Yeah.
94.5, so it's not quite in the middle. You could sell the 100s for $1, but the 90s are actually 90, 93, 94 cents. So
Right.
why are the puts not as why are you not getting as much from the puts than the calls, even though the at the money is closer to the 90 than the 100?
Oh, yeah, because of skew. So people are buying. Usually, people pay more for calls, right? Yeah, pay more for calls, less for puts.
Mm-hmm.
And so because people want the upside. So there's always going to be a little skew involved with options because people are like lottery ticket options. So you just got to be aware of that with your option trading. So sometimes it's one for one, and then also like you got to look at dividends. So sometimes and not necessarily TLT, but in stocks that own dividends, they're going to be off because the dividend is included in the call price. So things like that where you have to be aware of. So just little things like that.
Okay, cool. Awesome. Well, Barry, we really appreciate you coming on the show here. Love to have you back because I know that volatility is probably going to continue to pick up given all that's going on in the world. And but maybe you can leave listeners with some final thoughts on where they can find more about you and your fund.
Yeah, well, thanks, Kirk. Really appreciate again you guys having us on. Yeah, so I think just in general, like as I mentioned earlier, I think with times like we're in now with an election and the Fed and what's going on in macro, selling vol makes a lot of sense and do that conservatively, right? So we're covered option writing makes a lot of sense. And so we have three products that do that. Our main one is a mutual fund, and the symbol's EQTIX. And if you look it up on Morningstar, it's 5 stars, performed very well. Similar returns to the market, but less standard deviation, but also yielding about 8%. So that option premium is paid out quarterly to our clients. So if you're looking at something like for an income alternative, this makes a lot of sense. And as I mentioned before, it doesn't exactly return like fixed income, doesn't perform exactly like equities. It's kind of a mix between the two. So it might make sense to add it to your overall portfolio. But once again, thanks for having us on. I look forward to doing it again in the future.
Yeah, thanks for coming on, Barry. Really appreciate you sharing your wisdom with us. And yeah, we'll have you back in the future. Thank you.
Take care. See you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Barry. Really appreciate him coming on the show. Always have an appreciation for people who are using options because we do a lot of that. So it's always intriguing to me to hear how other people are seeing the world. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Good morning, everybody.
Yeah, great to see you here. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today?
Good, good. Well, Barb, let's kick us off. Barb, what you want to take the mic? Barb wants to interview us today, so
I do. I know that Kirk is an options aficionado / expert, and Phil, we have our tax guy here, and so I'm going to turn the mic on you guys. First of all, Kirk, covered call option. For those of our listeners who said, wow, that sounds great, it's a way to make money. What is it? Tell the listeners, what is covered call writing?
yeah, great question, Barb. Good way to start it off. So covered call writing, if you think of options, okay, options seem to be this complex thing, and they can be if you make them complex. You tend to get a lot of math people, engineers who love options because there's a lot of math involved. But you don't have to be that crazy with it. you can keep it really, really simple. And that's one thing I like about options is they are flexible and there's something for everybody. Now, covered call options, the best way I would describe it is if you own ABC company, and if there's a symbol ABC ticker, and I apologize, totally unintentional. So ABC company, let's say you own it at $100. Let's say you buy ABC at $100 and you think, you know what? I like it at this price, but it probably isn't going to move too much for the next 3 months. I think, it could sit here for a while and I'm okay with that. I want to generate some additional income on this position while I wait. So I do what you call a covered call option. And what it basically means is I give somebody the option to buy my stock at, let's say, $105. So if the stock goes up to 106, then somebody can buy the stock for me at 106 in the next 3 months. And if it doesn't go above 105 and 1 penny, then effectively I would get to keep what is called the option premium. Now, let's say in this case, I get $3. So I buy it at $100. I get $3 for the option that I'm giving somebody else to buy the stock for me at 105. So the outcome is this. If the stock goes above 105, then I make $3 plus the spread between 100 and 105. So I make $8 if in the next 3 months it goes up. That's 8% return in 3 months. That's pretty good. Annualized, that's what, 32%? That's pretty nice, right? It's better than you're getting in the index. So that's a really good rosy scenario. Here's another scenario. The stock doesn't move in 3 months. It's just 100. I get to keep the $3. That's 3% in 3 months. That's still 12% a year for doing nothing, for just sitting on the money. That's also pretty good. Let's talk about the bad scenarios. Bad scenarios are the stock goes up to 150, but you only make $8. You don't make the 50 because you're giving up the upside to somebody else. Somebody else is saying, I think the stock's going to go higher than 105 or technically 108 in the next 3 months. That's their bet. You're betting that it won't. So there's two sides to the trade, right? There's no winners or losers. Everyone decides, hey, this is the right price. So that's a bad scenario. You give up all that upside. Another bad scenario is that the stock goes down to 50. Well, if you own the stock, you lose 50. But if you have the covered call, you lose the 50, but you still have the 3. So technically you're only losing 47. So the benefits of covered call writing are it gives you some protection from a small amount of downside, and it allows you to earn income while you wait if you think the stock's not going to go anywhere for a while. So it is the most conservative option strategy. It's, well, let me say, one of the most conservative option strategies out there. If people in retirement can use it to generate income, it's a very popular strategy for people in retirement because if you already own the stock, all you're doing is you're just generating extra income. So a lot of people in that pre-retiree or retiree stage look at this as a way to generate additional income.
That was such a clear example. I think you should teach a course on this, Kirk. This was like really, really clear. Okay, now over to you, Phil. So your experience in options, tell us about it. Yes, no, do you use them? What are your thoughts?
So I've used them personally. There's a lot of them. I mean, Kirk just described like a very conservative, simple strategy, fairly easy to understand. There's all kinds of complex strategies. Like when I went through the CFA program, they covered a lot of different ones. There's straddles and things where you're buying puts and calls, and I'm not going to get into them. I'm just going to throw terms out rather than trying to give explanations. They're a way to leverage. They can have different durations. You can buy, like Kirk used the 3-month example. There's leaps which have a 2-year life. You can do shorter or longer time periods, and if it was a 2-year life, it can over time that life degrades. So like I've used them personally. My ADV allows me to use them, but I have not, because when I've tried to talk about them with clients, they're just not that interested. And if they're not that interested, it's not worth it. It was something I think that, especially when we had that zero interest rate policy, covered calls were really great during that period because it was a way to generate income when you couldn't. You have to be careful. The tax complications are different. I was saying before we got on the call, I started my career at Deloitte, and here I am, the new guy. And we had a client that traded a lot of options, and it wasn't just covered calls. He was buying what's called a naked call, where you don't own the underlying security. And nobody really knew what the tax implications were. And they gave them to me and said, here, Phil, you figure this out. So the basics, when you think about it, is if I'm on the other side of that trade, like if I bought that $3 call in Kirk's example, and then I exercise it, that $3 gets added to my cost basis for the stock. So, I exercise the option at 105 in his example. I paid $3 for the option. My basis in that stock is now 108. Right? If I write these options and they expire worthless, they generally result in short-term capital gains, not long-term. And remember that that's less favorable from a tax perspective than a long-term gain is, because short-term rates are the same as your ordinary tax rate. Sometimes the basis tax on to what you already own, and sometimes it doesn't. It depends on the transaction. So there's just lots of things to think about with options. I don't really get in. I said I've used them. I never have used any of those exotic strategies. I will also tell you that the data says that the real people that make the most money in options are the people that write them, not the people that buy them. Most options expire worthless. If you go back to Kirk's example, I had the stock at 100. I wrote an option at 105. That at the end of the month, the stock was somewhere 105 or less. And so therefore the person that wrote it, they collected their premium, but the other person just lost the money. The other thing you have to remember, options are associated with 100 shares of stock. So if you want to write covered calls, you have to own 100 shares. You can't completely cover your position if you only own 50 shares.
Another great, clear answer. So let's say I'm looking for additional income. And another thing that neither of you mentioned, which just seems logical, if the stock also pays a dividend, you're also getting that dividend if you are selling a covered call. So you get the premium from the sale of the covered call and you get the dividend. Is that correct?
That's correct.
Okay, so this sounds like a lot of work, though. How do you decide? 3 months, 6 months, 2 years? Which stock should I do it on? Do I have to, keep my eye on them? How much work is this type of strategy for someone that's thinking, I've got a little stock portfolio. I wouldn't mind making a little extra money.
Options can be complicated and they can be simple. The complexity that exists confuses a lot of people, but you don't have to go down the rabbit hole. It's there if you like math, if you're an engineer, if you like all the Greeks and all the stuff that go along with the options. It can be highly complicated and that can turn people off because, frankly, you could go really deep, but you don't have to. You can make it really simple. So here's a simple covered call strategy you can pursue. Well, there's a few. You could find a closed-end fund or ETF that does this. That's one way you could do it, right? They exist. You could use one of those, right? Simplify your life. Another way is you could find a manager that does this, or a few managers that do this, right? Or you could do it yourself. Now, basically what most managers will do is they will find a blue chip stock or a bucket of blue chip stocks, and they will write covered calls off that because it's more conservative. Now, generally speaking, the best strategy for covered calls is if you have a stock that's rising slightly, like a slow glide up, because they're either going to get called away or not. Either way, you're maximizing your output by doing that strategy. You don't want to pick a stock that's going up and down crazy because you're not going to get compensated for the risk you're taking, which is part of it, right? Is you're taking a risk by owning the stock. So if the stock goes down or up in a large way, that's a risk. You want to make sure you're mitigating that risk by not picking too volatile stocks. Now, volatile stocks will have a higher premium, so they're more attractive. It's like, wow, I get 20% for doing this. There's a reason you're getting 20% for doing this. Now, if you pick a stock that is suspect accounting and people think it might be worth zero, you could probably make 20% in like a week, but it also could go to zero, right? So you can't get, so sometimes people get allured by the big premiums. Don't. It's not worth that. Find a safe, easy stock that you can easily predict. I know predict in air quotes. Like ABC stock goes up 5% a year. Like look at property casualty insurers, for example. Those are smooth sailing kind of stocks. There's a slow glide up. Yeah, if you have a big hurricane, it's a problem. But without the hurricane, it's generally a pretty slow glide. They're somewhat predictable. Find a utility company, somewhat predictable. But you'll get lower yields from the covered calls from predictable. So you have to find something that is in a comfort zone. It also works if you have already own a stock. If you already own a stock and you're like, yeah, it's done pretty well. I don't think it'll go much further. Write a covered call. Get called away, so be it. You have to pay taxes, but profit's profit. So I think the covered call can be complicated or it could be simple. I'll tell you another strategy. There's something called a cash covered put. Now, a cash covered put has the identical risk parameters as the covered call. So effectively, your cash covered put, if you write a cash covered put, you basically don't have to buy the stock. You're only taking in the premium. Now you have to have cash to back it as if you did own the stock, but it's the same thing. Some companies will treat it the same. Like Schwab treats it the same. Fidelity does not. Fidelity thinks cash covered puts are more risky. They're actually identical in risk parameters. And this has been a problem with firms all over the place. Some firms say they're identical, some are not. They are identical. But it can be a simpler way to do it so you don't have so many moving parts. You're just having one position. You write a cash covered put. You just have to be prepared to own the stock at that price. So it's a different way to do it. I prefer that way because it's simpler to track. You don't have all these moving pieces. I mean, if you've got like 10 stocks, 10 covered calls, it gets messy. Sometimes it's easy just to do cash covered puts, take in the premium. Hopefully it goes up and you can just keep the premium, just keep doing that all day. So that's another way to do it to simplify the process.
Now, I don't understand how, okay, you have to have the cash. At what point then do you have to buy the stock and then deliver it? Where does that occur in the process?
In a cash covered put, you don't have to buy the stock. What happens is if you write a cash covered put at 100 and then it goes to 99 at expiration, you would have to buy the stock at 100. So basically what will happen is if you still own the put at expiration, the broker dealer or custodian will put the shares to you. So on Monday, you'll have 100 shares of that stock for every contract you have at that price. That's how it works. Now, you don't have to own it till expiration. Most people close it out. As Phil alluded, people say, well, the people who sell options are the beneficiaries. I'm not sure I hear that by everybody. I'm not sure I completely buy it because the math doesn't make sense. But regardless, it's probably more true than not, but we won't go down that rabbit hole. But the point is most people just get rid of it because they don't want to be put the shares. If you want to be put the shares, it's great. Warren Buffett actually does this as a way to own stocks he wants to own at a certain price. And if he never owns it, well, it doesn't matter because I've got cash. I'm sitting on cash. I can buy it at the right price. If I don't, I just earn extra income. So it's a great strategy for people who want to buy at a certain price and are waiting, and they'll just take in cash while they wait. So it can be a great strategy for that.
Okay. Now, Phil, talk to me a little bit about funds. Have you ever used them? What do you think of them in terms of using options with your clients or just with yourself?
The only time I've used them is if I have a client that has certain income needs and it's a way to give them some extra income. I use ETFs though. I don't like to use mutual funds because of the differences in tax efficiency between an ETF and a mutual fund. They're a way to generate income. I don't use them all that much. You want to be careful about what the expense ratios are because they can be expensive. There's one particular ETF that I've used, but only on a very limited basis. Personally, I haven't used them. I have, going to what Kirk just said, I have heard like the strategy that Buffett uses. To me, that's an interesting, I've thought about that. I've done it once or twice where I say, hey, I like ABC stock. I like it at $100 a share. It's trading at 110. If it falls to 100, I'm happy to own it. And I can write that put, and that's fine. And then if it gets to 100, now I own it, but I made a decision that that was a good price for me. I want to go back to something else that you asked about before, though, like how long, right? So actually one of my sons who was a computer science and math major, we were talking one day and I learned from him that he had to do the Black-Scholes formula. Black-Scholes is what I learned in the CFA program. That's what you use to value options. The two of the biggest elements in terms of setting a price are time and volatility. So if I have a call, the more time there is between now and when that expires, so like I talked about the leaps that are 2 years, there's going to be more premium in it for time, because the chances, if that ABC stock is at $100 and that leap is at 110, the chances of it getting from 100 to 110 over a year are typically going to be thought of as much greater than it would happen in 3 months or 1 month, right? Because they go down to zero in terms of time. So the time element of that valuation of the option is going to be greatest for longer periods. And so what happens is over time, the value of that option, that time element is going to decrease. And that's going to make the value fall, and the value of the option is going to fall over time just because of the passage of time. The other thing is volatility also affects it. Kirk talked about the stock that doesn't move a lot versus the stock that does. I remember on the call with Barry talked about value stocks are often better for covered calls, because typically we think of value stocks as being less volatile. There's less price movement. And if you're writing covered calls, you really want stocks that don't have a lot of price movement, as Kirk said. So the premium on a stock that doesn't move as much, that volatility premium is also going to be a little bit less. So you might not make, you could, as Kirk said, like if the stock is one that moves a lot, and right, then you're going to have a bigger time premium. You're going to get more when you buy that option, but there's just a lot more risk associated with it. So the ones that have less volatility and less time, those are the cheapest options in general.
And Phil, you alluded to knowing a little bit about the research. So overall, can you speak to that a little more? What does the data say about how successful using options are? Let's just go with the covered calls versus a buy and hold strategy. Is there any data that you're aware of that suggests whether this is statistically a good path for someone that has some curiosity about whether this would work for him or her?
So I think pairing a buy and hold strategy with covered calls is a nice conservative way to build income, because like I said, if we have these stocks that don't have a lot of volatility, I can get a little bit extra, right? The stock might pay a dividend, might not, right? If it pays a dividend, I'm kind of goosing the dividend by adding in the potential option premium. If the stock doesn't pay a dividend, it's a way that I can generate. And I know I have a friend from the days that I wrote for the Motley Fool. He used to run a mutual fund, and that mutual fund used a covered call strategy. And one of the things that allowed him to do was he could put stocks in the portfolio that didn't pay dividends, because he could write covered calls and still produce income, because it's an income focused fund. Like I said, the data that I've seen, I can't quote the specifics because it's been too long since I've looked at it, but it basically says that the person who writes the call is the one that's normally, in our example, if we're using calls, is the one that usually makes the money, because of the fact that the stocks don't usually hit those prices more often than not. So if you buy the call, if we go back to Kirk's example, I buy the call to buy it at 105. You know, if the stock is 106, I'm still going to exercise my option because I'm buying like, but I'm reducing my loss from $3 to $2. If it's at 104, I don't want to exercise my option. I'm just going to take my $3 loss and move on. But because of the fact that we have these time and these volatility factors that govern what the price of the option is, that to me supports the idea that, you know, we're just making it harder to win if we start to add these extra things in. But covered calls are conservative, and they're just a way to get a little bit of extra income. And that strategy is like, if I look at the funds that have done it, they do have positive, you know, they typically have positive returns. Maybe they don't beat the market, but at least they have positive returns.
Now, Kirk, we're talking conservative option strategies. Does this mean this type of strategy is more applicable for someone who's older, in or near retirement, and needs the income versus a younger person who is looking more towards growth?
It doesn't have to be. I mean, if you think about portfolios, Wall Street has made it obnoxiously simple to think about portfolios. You're either in a conservative bucket, a moderate, or an aggressive bucket. And if you're in the aggressive, you're taking more risk. In the conservative, you're not taking risk. Realistically, it doesn't have to be that way. There are ways you can be in the aggressive bucket and not take a lot of risk and still do okay. Like things are too simple many times. Now, there are many, the way I think about it is there are different seasons for different strategies. So pretty much for the last like 15 years, the season was all tech all the time. Value was out of favor. Now, you could be a value investor and you would underperform for a long period of time. Does that mean value is bad? No, it just means it's not in favor. What about US versus international? Also, US has been in favor, international has been out of favor for a long time. That trend eventually will change. Same thing with large versus small. These trends change. They've just been very one-sided for long periods of time. And it's very probabilistically, it's very unlikely that that continues. But it may. You never know. So the point being is just because you're a aggressive investor doesn't mean you can't use covered calls. Because if we're in a flat environment, the best strategy to use, well, one of the best strategies to use in a flat environment are covered calls. So think of it this way. Stocks can go up, they can go down, or they can go sideways. That's the only thing stocks can do, up, down, or sideways. Now, you can make money on one of those things, up, down, or sideways, or you can make money on two of those things, but you can't make money on all three. So there's always going to be one that is not going to work for you. So if you use covered calls, up or sideways, you'll make money. Down, you won't. If you're buying a put, down works, up or sideways won't, right? So each strategy has its good and bad points, and it's totally dependent upon the strategy and what you're trying to accomplish. But generally speaking, you want to have a strategy that aligns with the season. So if the season is everything's going up, then if you do a covered call, you're missing out on upside. And maybe there's a better strategy. Maybe you should buy some conservative stocks that are making more money, right? If things are going down, then covered calls aren't going to really protect you. They'll provide a little protection, but if it goes down 50%, there's not a lot of protection there. So think about what is the season that you're in and what is the strategy you're trying to, or what is the outcome you're trying to produce. I think that's really important, is understanding what is the outcome that you would like. Because if you know that, then you'll know how to proceed. So sometimes, for example, I was using covered call strategies up until 2017, I think it was, or 16 or 17. And the premiums got really skinny. Like you were not making, it was not worth the premium. Like you weren't getting paid for the risk of the premium. So we just stopped doing them. If anything, we reversed it. We started buying calls instead of selling them because it was so cheap figured, well, if we can't sell them, maybe we should buy them. And it worked because they were so cheap. So options is about understanding the outcome you're trying to derive. You don't just willy-nilly buy and sell options. You have to be clearly defined of what is the outcome you want. Because if you're not comfortable with an outcome, then you shouldn't be doing the strategy, right? If you think that, so like, well, I'll give you an example. I was reading an article the other day about Robinhood and how they had that unlimited cheat code, which basically was an error on their platform, which allowed people to continue to write options even though they didn't have enough cash. And what it did was it put the cash back and allowed you to leverage that more. So people just kept selling options like millions and millions of dollars, even though they had like $10,000 in their account. Like I mean, one penny move could basically put your account underwater and could cause them to come send the leg breaker to collect. Like it's not allowed for very specific reasons, because the broker doesn't want to be liable for the risk, and also because it's not right for the consumer, because they don't want to be liable for the risk either. So there are things that are dangerous. You have to know what you're doing. But if you know what you're doing and you have a solid strategy and you know what the outcomes potentially could be, then do that, right? So it's all about aligning outcome with strategy.
Now, my personal belief, although I've done a little options trading, but not a lot, and I believe that you need to really educate yourself first. But if you do educate yourself, a conservative strategy like writing or selling a covered call option is a viable investment strategy. The Chicago Board of Options Exchange, or CBOE, has some very legitimate courses to teach you about options trading if you're interested. Do either of you know of any other places where you can get decent options trading education?
The CBOE and the OIC, I think it is, the Options Industry Council, they used to have great, seeing if I can find it. There's so many OICs, so let me just look it up. But they used to have a great website with tons of very good educational content. They've changed their website around, so I'm not 100% sure. But honestly, there are so many ways you can get educated with options. Those are some great tools, as you said, Barb. But you know, the thing about options is you just need to spend some time and learn it. There's some good books out there. You can get one of those dummies books. The challenge I think people get is when you get past the simple facade of options, it can get really complicated, and then people get squirrely because they're like, I don't understand Greeks. This is weird. I'm just going to stop. You really don't need to understand the Greeks. You can, it helps, but you don't need to. You just look at the math. I'm doing a covered call at this price. I'm getting paid this amount. Does this make sense for me? That's all you need to know, right? If you're selling covered calls. If you're buying them, here's what's going to cost me. Where do I think the stock's going to go? I think it's going to go up. Great. Here's what I'm going to do. There are some simple ways to do it. Once you get into the Greeks and all that, it can get overwhelming really quickly. But like I said, you don't need to know them. Frankly, deltas pretty much all most people ever need to know, and that's even that you don't really need it, but it helps. So that would be my suggestion. I don't know if you have any, Phil.
I agree about the CBOE. Beyond that, there's some books. I know Macmillan has a book on options, but it's going to get into a lot more strategies than what we talked about here. I tend to think that those other strategies, a lot of them are for hedging, right? Like to protect your downside and things like that. I don't believe in the Greeks either. What Kirk said makes a lot of sense to me. Like, let's look at the stock, let's look at what I'm getting, and keep it simple. I don't really want to get into those exotic things. If you want that, like I said, that Macmillan book, I know I've been through some of it. He does a really good job, but that's when you're starting to get into these really exotic strategies where you're buying calls and puts at the same time, and there's straddles and collars and all kinds of things like that. I just don't think that's necessary. I think that the things that we've talked about are enough for the average investor to worry about. But the CBOE, definitely that's a good source. If you're looking for something free and easy that you can find on the internet, that's a good place to start.
Thank you both. I think this was a really good primer, an introduction into options. And if you're interested in learning more, we've given you some decent resources. Many of the trading platforms offer a paper trading account. And what that means is you can get some play money. You can play around with different strategies, try them out, see if you like it, see if the what you're learning, put it into action, see if it works for you. And I think that's another great way to get your feet wet. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and on YouTube. Phil, I'm going to turn it over to you to give your final thoughts, and then Kirk, you can wrap it up.
Thanks, Barb. So I guess the main thing is, as we've talked about here, if you're going to do this, try to keep to the KISS method. Keep it simple, stupid, right? Don't make it too complicated. They can be a great source of income, but you have to pay attention, and you have to decide, is this something I want to do all the time, something I want to do once in a while, because those are different things. But for most people, I think you don't need this, because it's just adding more complexity to what you're doing. As for me, I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm is Applied Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook, and you can also sign up for our blog. Thanks for having me today. Enjoyed it.
Yeah, thanks for you both for coming on. And one more point about options. I want to point out that options were originally created to hedge positions. They were there to manage risk. That is what options do. They manage risk. You can speculate with them, but that's not their intention. Their intention is to manage risk. Now, even speculating is managing risk. It's just a question of whether you understand how to do it properly. So I wouldn't go crazy with options, as Phil said. You can keep it simple. There are very simple strategies you can use, and there's very complicated strategies. If you're going for a complicated strategy, you have to manage that, and that can be really challenging. So I would recommend keeping it simple. Go for simpler strategies, trying to produce an outcome. If you're going to do them at all, you don't need them. And by the way, there are plenty of ETFs out there. There are structured products out there that do these things, so you don't have to. They will literally create. So structured products basically were designed. They came out at Paine-Webber. I think Paine-Webber was one of the first, if not the first, or maybe it was Smith Barney. One of the two was the first, but came out with structured products. Is basically what they started with was covered calls. And they wrapped a wrapper around it and said, hey, buy this covered call. They didn't call it that. They called it something else, but it was basically a covered call strategy. And it was simple. You just buy it. Here's your outcome. If this happens, this happens. If this happens, this happens. Simple, right? So there are plenty of ways now that you can actually buy into some of these strategies. So I would do some research. If options make you squirrely, find ETFs, find closed-end funds, find structured products that will do the strategy you're going to do, and try that. That's a simpler approach as well. So it's just another way to approach the problem if you feel overwhelmed by the complexity of it. Don't be afraid. We didn't get into all the complexity, but don't be afraid to just find people that are already doing it, because there are quite a few now. I think we're fortunate in that way.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.